Okay, so good morning, everyone. Welcome to today's macro snapshot. We are February the 19th. It's a Wednesday, recording this about 7:20 in the morning. Okay, so let's see a little bit what's going on. Not a huge amount of data, but what I would say is that we are starting to see some, how can I call it, some sort of reaction to some of the geopolitical stuff. We saw yesterday that a Russian delegation met with the US delegation in Saudi Arabia, of all places. I guess they were speaking about energy. And it was interesting because although the comments from the American and the Russian side were relatively, I would say, positive, they were also guarded in the sense that Lavrov, the Russian foreign minister, issued a statement saying that this was a useful first meeting. And what was his quote? He said, I am not unhappy. So, sort of a double negative there, I guess, is a positive. But I think also we had Zelensky, the Ukrainian president, canceling symbolically a scheduled meeting for Saudi Arabia. We also had a lot of talk from the European Union continuing to do their sort of other meetings on the sidelines. So I think, yes, it seems as though we are moving towards some kind of negotiated settlement. And Zelensky this morning himself was saying that he wants the war to end by the end of the year, which is, 10 months away. But I think the overall reaction is to say, and of course, Trump yesterday at Mar-a-Lago was going on about how he would solve everything in 2 minutes, and everyone else was making mistakes. But anyway, the point is, from a market perspective, I think the market is saying, okay, yes, we are somehow getting towards some kind of negotiated settlement, but this could take several months. It's going to be messy. There's going to be compromises, and it's not necessarily going to be a quick fix. That's my takeaway anyway. Well, at least that's my opinion. The market is still in a relatively positive vein. But again, just last night, we also, again, a Trumpety sort of impromptu kind of press briefing, if you could call it that. He reiterated the fact that, Europe was treating America horribly in terms of trade, that he wanted 25% tariffs coming at some point on possibly on cars, on pharmaceutical products, and also on computer chips. And he keeps on floating. He said, we'll be coming up with a decision in the next couple of weeks or by April the 2nd. So my personal view, and again, it's just a personal view, is that although we will probably get not the full, 20 or 30% universal tariffs, it does seem to me that somehow in a scrambled, incoherent way, the US will, in some shape or form, be imposing some form of tariffs on Europe and potentially other trading partners, within the next 2, 3, 4, 5, 6 weeks. I have no idea exactly what the specifics will be, but I think the market is starting to, it has sort of ignored that, but we're starting to see a few cracks in the technicals as well. And that was possibly helped this morning. We had Schnabel from the ECB, and I'll try and find the headlines here because we actually had, now Isabel Schnabel is on the governing council of the ECB, and she's considered one of the intellectual sort of foundations of the ECB's policy, very well respected. And when she talks, the market listens and the ECB listens. And I can't, let's have a look here. I think I need to go to maybe page 2 of the headlines. Yeah, because this came out about 6 o'clock this morning. So it's quite interesting here to look at some of her. It was quite hawkish. I mean, Schnabel was saying risks to inflation outlook somewhat skewed to the upside. So that's not dovish. She's also saying still need to see deceleration in wage growth. So basically saying that wages are still heading on the up. Many indications that wage growth will decelerate. Okay, that's a little bit ambiguous. Services inflation should start to come down. So there is something, but she's also saying would exclude a rate increase. But if you actually look here, it's firmly believe in meeting by meeting approach. We've seen new shocks to energy prices and oil going up today. Wage growth still elevated. Domestic inflation is still strong. And this is interesting here. Should discuss dropping restrictive label in March. So this whole idea that the Lagarde has been saying, we're restrictive, we're above the neutral rate. Schnabel here coming in and sort of saying, well, actually, I think we should stop this. I'm not sure we are that restrictive anymore. And also saying that can't say with confidence that policy is still restrictive. Bottom line here is that Schnabel, who, as I said, is a very influential member of the governing council in Europe, is sort of saying, whoa, let's just calm down here. And we had, I think it was, who was it the other day? Was it Cipollone or someone from the governing council? I think it was yesterday, also saying that, we need to, just maybe slow down a little bit. So sort of interesting just to think that maybe in the Eurozone space, and we can just bring up the expectations here, a little bit of caution. Now, the market is still pricing in by the end of this year, almost 3 cuts. And let's just actually see if that moved a little bit. I'm just kind of curious to see if that moved I'm not sure it'll pick up in here, just on the back of Schnabel's comments. Yeah, and so you can what you can see here is that this is Schnabel's comments. This is an intraday, so this is just a tick chart, so very short term. You can see here when those comments came out around about 6 o'clock, the market had been pricing in cumulatively by the end of 2025. It looks about 76.5 basis points, and you can see that it quickly took off about 4 to 5 basis points of dovish pricing. So that definitely got the market's attention. And we can see that that also maybe could have a bit of an effect on Euro stocks, because one of the narratives of the Euro stock outperformance, which has been incredible this year, is this whole idea that Europe is going to be cutting aggressively. Energy prices are coming down because of a quick resolution to the Ukraine-Russia situation. There'll be a peace dividend. There'll be a lot of reconstruction and building and engineering projects in Ukraine, and maybe, who knows, also in Gaza. But I think just the last 24 hours has been a little bit of a sort of reality check that actually the diplomatic situation in Russia-Ukraine, whilst seeming to progress, still faces many hurdles. And of course, our friend Donald Trump, as I said yesterday afternoon, I think it was about 4 o'clock, again, coming out with pretty antagonistic comments, essentially saying Europe's treating us badly, we're going to put tariffs on 25%, et cetera, et cetera. So putting that all together, we are getting just a little bit of a reality check. And that's interesting because we're starting to see, the euro just coming under a bit of pressure again. And this whole idea that maybe flows will start going back to the US, who knows? What's interesting here, guys, I've got the Goldman Sachs US dollar trade weighted index. So this is not just sort of exchange rates against other fiat currencies. This is actually, weighted with trading volumes and whatnot. And it's quite interesting if you obviously see that since September, October, this trade weighted index of the US dollar, as I say, from Goldman Sachs, here on the Bloomberg terminal, it's gone up and it's sort of softened a little bit. But the point I'm trying to make, if you actually take this back long term, so let's go back a long way. Let's go back, I don't know, like even maybe 40 years, I think we can go back, put it in perspective. Look at that. So you can see that going all the way back to the 80s, we've come a long way, then it's kind of stabilized. And basically for the last 4, 5, 6 years, we're almost at highs. Like literally, a couple of months ago, we're at the trade weighted index of the US dollar was at highs. And the reason I'm showing you this graph, because it's interesting, this idea of what will Trump do with the dollar, because we know that, during the election campaigns, Trump was saying, oh, we need to bring manufacturing back. So one way of doing that is through tariff impositions. But the second way, which is probably going to be more effective and ultimately is what needs to happen if the US wants to be more competitive from a manufacturing export point of view, is actually to get the dollar down. And Trump is on record as saying that, the dollar is too strong. And it's quite interesting just to step back and get a bit of historical perspective from a trade weighted sort of point of view. And you see that the US dollar indeed is historically, compared to all its trading partners, at the strongest level. And if you actually look at fair value, as they say, fair value models for things like the Chinese renminbi or the Japanese yen, they are still undervalued, especially the Chinese renminbi. So it's going to be kind of interesting just to see what happens in trade policy next few weeks. Obviously, we'll be talking a lot about tariffs, but I think I'm just curious to know whether behind the scenes, Besant at the Treasury and Trump are talking about some way of just letting this dollar drift down. We shall see. But it's going to be tricky because as long as we have geopolitics, and if European exceptionalism story sort of starts to go off the boil, the flows will go back into the US. Okay, so let's just get back to a couple of charts, which I'll do by stop sharing, get back to the charts. Okay, so I just want to look at some things happening in Europe. Again, we see for the first time in a while, we see the Euro stocks over in Europe, which is here. We see the Euro stocks actually coming off a little bit today, so I hope that's the case, because I am short the Euro stocks after this outperform. And you see it closed on the daily Bollinger Bands, which is this upper red one here, a couple of times. Still could go up a little bit, but I do think this is sort of maybe the path that might just sort of spike up even a little bit more and then gradually drift down, even just for a regular collection. So we're seeing the Euro stocks coming off again, maybe on more talk about tariffs, maybe on the idea that the Russia-Ukraine resolution will be more complicated, and maybe also just the fact that Schnabel is starting to say, hey guys, the ECB maybe is not going to be cutting as aggressively as you had hoped. So I think those three factors giving a little bit of a reality check to European stocks here. And if we look at the German ones, the DAX also coming down a little bit. So starting to see a little bit of just kind of consolidation here and maybe a little bit of distribution. On the other hand, the US stocks are doing quite well. Let's have a look at that. US stocks, again, at the top of the Bollinger Bands. They did hit new highs yesterday or along the highs in the ES here, but you can see hitting up against the top of the daily Bollinger Bands here and just finding it difficult to go higher. Which is interesting because you see the VIX here, the VIX has gone up a little bit. The VIX at pretty low levels, and you can see that reflected if we look at something like the option chain on the ES futures, which I've got up here. As I say, this is like 7:30 in the morning here. You can see at the money, this is like the 0 DTE, but it gives you a sense here. You can see the implied volatility overall, 10.2 here on the ES futures options, very, very, very low, in a very low percentile. If you look at the 52-day percentile, very, very low. And so you can see here, only 10 points basically for an at-the-money put, or 12 points essentially for an at-the-money call. So very, very low vol, which ordinarily would probably in theory should help the stocks to push to a new high. But I think there's just a lot of uncertainty. People are also talking about OPEX. So the option expiry is happening on the 21st. That's happening on Friday. So there's a lot of technical talk about gamma pins and all this kind of stuff that maybe the market makers, they're buying any dips and they're selling any rallies and everything's just sort of pinned. But once all those option hedges come off on Friday, which is the 21st of February, the big option expiry, then possibly the market will have a bit more volatility, maybe to the upside, can break down, or even to the downside. One thing I also do want to talk about, there was a lot of talk yesterday in the context of geopolitics about the joint issuance, potential joint issuance in Europe of Eurobonds to pay for defense. Now, you know that the requirement, not the requirements, the expectations and the hope is to spend 3 or 4, 5% of GDP. A lot of countries are not even at 2%. Countries like Belgium, but especially the peripheral countries, Spain, Italy, and Greece, do not at all spend. I think it's like 1.5%, 1% of their GDP on defense. And countries like Italy are very, very heavily indebted. So it's kind of interesting because one immediate reaction to that I was thinking is like, well, okay, if places like Italy, which already has 140% of GDP as a debt level, could that be a possibility that they need to, like the spread needs to widen basically between, for example, Italian BTPs and German bunds, in the sense that if Italy has to issue more debt, that was going to be bad for their rating, which should cause the spread to go up. But actually what you can see here is that yesterday, no problem. This is the spread between the BTPs and the German bunds. It's down to just over 1%, which historically we can see is very, very low, just going all the way back for a few years. So this to me is quite interesting because the market obviously is taking this to say, well, hey, if it's going to be joint issuance, so not just individual countries, but a joint Eurozone, that essentially means that the fiscally more conservative countries like Holland or Germany will, in a sense, kind of subsidize the peripheral nations like Portugal and Spain and Italy. But that's very interesting. I'm just curious to know how long can this go on? Like, how long will the German sort of political scene be sort of happy, so to speak, to keep on bailing out some of these sort of peripheral countries? So that's definitely something I want to be looking at. And I think over time, this should really sort of head up. But again, we have the German elections this Sunday. So that will give us a bit more clarity. We'll talk about that maybe the next couple of days. But that's an interesting one there, because if the Italians and the Spanish and the Portuguese do have to start spending more of their budget, which is already very, very stretched on defense spending, surely there's going to be a little more pressure by the market. And I feel this is something which at a certain point could start representing a good risk reward. That's my personal feeling. We'll keep on going on that one. Okay, just a couple of other things, guys. We have the FOMC minutes today. Interesting. We know we had Waller a couple of days ago, as we said, who was sort of neutral and even a little bit hawkish. We've had a lot of sort of Fed speak recently, essentially saying that, we're on pause, we're waiting for, sort of good news on inflation. And I think that the risk today is at 2 p.m. We do get the FOMC minutes from the last meeting at which they paused, if you remember. And I think the risk today is that will reinforce that, I don't want to say necessarily hawkish message, but the message that the Fed is definitely on an extended pause, waiting until they get a lot of consecutive months of good data which is to say, inflation going down. The only thing I think which will really cause the Fed at this point to continue with a cutting cycle, as I think I said yesterday, would be a significant and fairly dramatic and consecutive slowdown in growth data. So we're talking unemployment rates shooting up, unemployment collapsing. We're talking growth rates, retail sales collapsing. So we haven't quite seen that yet. Some signs of sort of weakness. For example, yesterday I was looking at a chart which was saying that 90-day delinquencies, so late payments on credit cards, that's actually spiking up quite a lot. So are we starting to get some cracks in the in the system? Having said that, if you look at that, I mean, just to have a quick look at credit markets here. This is something which I find kind of interesting. If you look at, sorry, a lot of stuff up here. So I just want to look at, if you look at some of the credit spreads here, developed markets. So let's say, for example, if you look at investment grade, this is in the US investment grade. So this is, look at this. This is very, very, very low. So obviously up in COVID, where there's a lot of stress in the system, we're up at about 375 basis points over treasuries, above treasuries. We had, when we had the banking crisis, the Silicon Valley Bank, we had that spiking up a little bit. But ever since then, investment grade credit now, there's only a premium of essentially 77 basis points above treasuries. And if you look at the even the high yield now, let's see, we'll say, okay, is there any stress in the credit markets, high yield? Again, you can see that if we go back all the way back to COVID, let's see if we can pull this back a little bit. I mean, again, this is the look at that. So COVID at that point, over 10%. So a huge spike. And then with the Silicon Valley kind of mini banking crisis up to, about 5% or so. But look at that. Same thing as of investment grade. We also see that the high yield is just now down to about 250 basis points. So the point I'm trying to make here is that although, some people say, oh, credit card things are going up, credit card delinquencies are going up, the retail sales was a bit soft, the credit markets are still extremely relaxed, still saying, hey, there's no problem, there's no structural problems in everything. So this is definitely something I'm looking at. And also, I recommend, I'm just looking at the spreads here. So you've got the high yield minus investment grade. And what you guys can see here is that's still pretty benign. So to give you a context here, there's COVID. It was at about, almost 7%. And then with the Silicon Valley business up to about, almost 4%. But here we are under 2% at 1.79. So those spreads very, very comfortable. No problem now with the high yield. So what I'm trying to say is that the conditions still remain relatively good. We have, relatively low volatility. We have stocks at high. We have employment, which is strong. The economy is still going on. So the point is that the Fed, getting back to the Fed and the Fed minutes today, I think it makes sense for the Fed just to say, hey, economy is in a good spot. We're not doing anything for several months, which to me means that the front end of the curve, as I keep on saying, is probably going to be relatively anchored, maybe going up and down a little bit, 5 or 10 basis points on headlines and, a bit of sort of economic data. But really, we're going to see the growth situation will be reflected in the back end of the curve. So that's what I expect at the moment. Just a couple of quick things also to finish on here, guys. Oil, I'm just looking at the chart here, having a pretty good pop up with oil. And if we actually look here, let's just look at the curve. This is the live curve. So you see here, it's fractionally into backwardation. So, yesterday I was talking about that. If we look, let's say a day ago, you can see that the price has gone up in the shape of the curve. And let's say we look at a week ago, and I'll just zoom in here. So kind of interesting to see what's going on here with the oil curve. So this is the live data is the white, and then yesterday is the purple here, and then the yellow. So the price is going up. And you can also see the shape of the curve is, sort of slowly trying to push up just a little bit. So the oil, having a little bit of a breakout here, and we'll just put it on the outright chart, or put it on the front contract here, if I can find it. There we go, CL1. I think we're rolled over to April at this point. And so what you can see here is just sort of breaking out a little bit. It bounced off this sort of downtrend line here. You can see here, just right in the middle of the Bollinger Bands. So really for the bulls, it really has to push above those Bollinger Bands. There's your 200-day EMA here. This is the 100-day EMA. So we've got a little bit of technical resistance, but this is a promising attempt to rally. I'm not expecting a huge rally because I do believe the markets are still balanced. So why would oil push out? Again, we had drone attacks overnight. I think somewhere in the Volga Basin from the Ukrainians. taking a little bit of supply offline. But symbolically, it's saying that the war is not over, the negotiations are not concluded, and that there are still sanctions on Russian oil. The other issue as well is that we had very cold weather across North America. In fact, we still have very cold weather across parts of North America. And that's basically freezing some of the pipelines in places like North Dakota. So there's a few 100,000 barrels offline. So that's briefly supporting oil. And I think also, just this idea that the global economy is doing relatively well. And also, probably the most important thing is that we had a lot of comments over the last day or two, essentially saying that OPEC Plus is considering not increasing their production output as had been scheduled for April. Again, probably a short squeeze. We know that open interest is the lowest it's been for a couple of years. So everyone's short and there's not that much interest in the market. So this could just be a short squeeze, because everyone is short at the moment from a positioning point of view. So again, I don't expect this to go miles. Who knows, maybe a push up to the 200-day EMA, which would be on the front contract here about $73.70. But an interesting one nonetheless. And of course, as oil prices going up, that's going to put a little bit of upward pressure on the yields. Especially like the US 10 and 30 year, which we could see, maybe look at the 30 year. So yeah, so you can see that the yields have been going up, just pushing up a little bit in the 10 and the 30 year space in the US over the last couple of days as well, which again is going to be a little bit supportive for the US dollar, which is, of course, is reflected in the fact that the euro coming down partly because of US dollar and the yields, but also, as I say, just this idea that, maybe not all is sort of easy peasy over in Eastern Europe and Russia and Ukraine, and that the Americans, in the form of Donald Trump, are still thinking about tariffs. So looks like euro under a little bit of pressure as well this morning. Just finally, guys, very, very quickly, we had the Reserve Bank of New Zealand last night cutting 50 basis points. That was expected, but interesting, just the reaction. You can see here, not really collapsing, actually had a little bit of a pop for a couple of hours. Listen, the New Zealand dollar, so why would it pop a little bit? Just because the terminal rate, the market had feared that may have been revised downwards, but Governor Orr basically kept it, or the Reserve Bank Board kept it at 3.1%. So the terminal rate stayed where it was and was not revised downwards. So that, at the margin is a little bit supportive or hawkish. The thing is that the Reserve Bank of New Zealand was one of the first developed market banks to cut aggressively, and they have cut aggressively. And as we saw last night, another 50 basis points of cuts. So in a certain sense, you could say that they are well positioned in terms of stimulating their economy to maybe deal with any fallout from, trade wars or even a global recession or something like that. But the reality is, that as long as there are threats about sort of tariffs and trade wars, and especially being fairly exposed to China, you've got to say that the New Zealand dollar is under a little bit of pressure, although they have acted early. So what could be quite interesting is to look at, let's say, compared to the Australian dollar here, and we see that the Aussie dollar actually interesting, kind of being rejected at this triple top here. The Australian economy is actually on a proportionate basis more exposed to China in terms of percentage of exports. Australia exports, I think it's about 10 or 11%. No, actually, it's about 30% to China and about 10% to the US, whereas New Zealand is a little less to China and a lot less to the US. So could be interesting just internally as a little trade is to think that maybe, Aussie, New Zealand dollar, is that a top here? And maybe this could just drift back down into the trade range. Okay, guys, I'm going to leave it there. No data today. We do have, watch out, we'll probably get Trump sort of news conferences, and we do have the FOMC minutes at 2 o'clock, which, as I say, is expected just to reinforce this idea, not necessarily of being super hawkish and certainly not a hike, but maybe this idea that, cuts are, 2 or 3 meetings away. Thank you. Have a great day and stay warm.